Let's bring in Omar Aguilar. He's at Charles Schwab's Investment Management Senior Vice President and Chief Investment Officer of Passive Equities and Multi-asset Strategies. Omar, it's great to see you again. We're seeing small losses in the Dow and the NASDAQ today, not too far from those record highs, though, that we saw earlier this week. What do you think of the market at these current levels that we're seeing today?
Hi, good to see you too. Well, today it's just like yesterday, just a little bit of a breather after a very strong rally that we saw towards the end of the first quarter and a very strong first quarter. Not surprising to see that investors are starting to go back to fundamentals, which is good news for the market, where, a lot of the debate right now among investors is what comes next and what are the catalysts that will propel us to the next leg of the bull market. All indications, whether it's macroeconomic data or micro data on expectations about earnings starting next week, are all pointing out to the next, leg of the bull market. And I think at this moment, it's just about the catalyst on how you position that. The good news is that investors are looking for data to support the decisions to come into the market or leaving the market.
Now, Omar, I want to ask, it's Brian Cheung. I want to ask what types of other trends you expect to happen as a result of maybe that shift to the fundamentals. I mean, should we expect to continue to see bond yields rise higher, a U.S. dollar get stronger, or are those dynamics separate from what you're trying to talk about right here?
Yeah, so we're just still in probably the early parts of the expansionary cycle after recovering from that recession. So that first part, after the recession is over or the recession passed and we started healing, a lot of that is as a result of the vaccines rolled out. We started to see that cyclical trade, playing, a big role in the early part of the cycle. Normally what happens at this stage is that you continue to see, maybe not as strong, but still the cyclical component will continue to drive leadership into the second part of this year, into next year. A lot of that, what we'll do is we'll see the trends into risky assets. You will see risk premiums is still looking pretty attractive. You will see the value trade continue to work. You will see, the rotation into small caps, into areas that benefit from that cyclical trade when you have low interest rates, very tame inflation, and then you see the extra stimulus, will continue to have. I would probably say that the biggest part of what we're watching at is how much the market has been pricing the potential for record level of consumer, spending in the second part of this year. I think that's probably the part that will trigger a little bit more volatility for the second part of the year, but also could actually make the bull market even stronger.
And Omar, what about the prospect of higher taxes? How is the market looking at that?
Well, so far, the discussion related to infrastructure spending, as well as the combination with the tax increase, a corporate tax increase, it is something that the market is still not, pricing in. I certainly think that the timing of when these will go seems to be at least put towards the third quarter of the year, as opposed to any time now. Depending on how these play out, and there's still a lot of uncertainty on how politically these will play out between the size of the infrastructure spending, as well as the potential for corporate taxes, those two will play each other out. Historically, they could be canceling, each other out. It doesn't necessarily mean that, certain, companies will not be affected, but as the general economy, as well as the general stock market, it will actually be a function on how big is the spending on infrastructure relative to the size of the corporate tax bill.